welcome everyone. We are pleased to have everyone out at North Coast Angel Fund's 4th education session this year on deal terms. This was the most requested session when we did feedback surveys last year. So we salute you for actually showing up. We have a couple parting gifts in the way of term sheets and glossaries, which we hope you'll like. We'll have a lot of time for questions in addition to the panels, and we'll get started. Daniel is reminding me that, like the other education sessions, as an inducement to everyone to stay around till the end, the guests in attendance are all eligible for a drawing to win a bottle of Angel's Envy Kentucky Bourbon, which has become our calling card drink. We recommend it highly. Whether you are a member of an angel group, an individual angel, it really is something which you should consider.
Is this one full?
For now, it's full. Let's see how the night goes. Okay. Before we get going, though, I want to take a moment and just thank our primary sponsor of the Angel Education Sessions, the Brendon B. Morgan Foundation. Their mission is to drive entrepreneurship education, and they, like we, are convinced that a big part of this is engaging and convening the angel community. And you may note that about half of the people here in attendance tonight are non-members of North Coast Angel Fund. And this Angel Education Series is intended to engage a much broader group than just our members, because our feeling is that the more angels, whether they're members of our group or not, that are making good decisions, getting involved in deals, becoming more educated and engaged, the better it is for the whole ecosystem, and the more likely companies are to be successful, the more likely investors are to be successful. And it's part of what we think we need to develop a more cohesive group of angels in the future. There are 3 more sessions this year. Feel free to join us for all of these. We're going to constantly tweak these as they come closer based on feedback, which we'll ask you all to provide here tonight on the blue forms in front of you. Also want to take a moment to acknowledge our broader Innovation Council. This is a group of companies, firms, institutions in Cleveland that have committed to support our group, who have committed to be here in person for many of these events. And part of what that allows us to do is to convene groups, to have food and drink and location, and to drive angel investing activities. So we appreciate their support, and you will note for the individuals in the room who are from companies that are Innovation Council members, there is a blue ribbon on their name badges, so please ask them what they do. So I'd like to take a moment also to thank our panelists. We're appreciative of a lot of really high quality people giving us the time and effort here. We also want to acknowledge the lack of diversity on the panel that we have tonight. When we put this together, we said, boy, we kind of missed the mark there. No, it wasn't for lack of effort. We have a pretty good bench at North Coast Angel Fund within our membership and a broader set of people, and we happened to strike out on just about everybody that we reached out to, which tells us we need a deeper bench, because there are a lot of people who can and should be part of the conversation that are not necessarily. So to the extent that includes some of you in the room, please let us know. And if there are people that you are aware of that you see this and say, boy, these people should also be engaged in this activity or be on panels like this, please do let us know, and we'll make sure that happens in the near term. So we're going to start with an overview of deal terms, try to set the table a little bit for the rest of the session, and then have 3 panels. We're going to have a high-level intro panel. We'll then have a panel on the economics of the deal, the economic aspects of the deal, then a panel on the governance, the rights, the protective provisions. Those are both areas where you can improve a deal, you can improve the outcome, or you can cause a lot of headaches for the future, and we'll get into as much detail as we can. So there are almost countless ways to structure an early stage deal, and I think most people who've done this at any level will say that creativity is generally not rewarded in structuring early stage deals, right? The simpler, the cleaner, the more understandable, the more reproducible, the better. That said, there are different flavors of equity when what you're buying is a piece of ownership of the company. Those flavors of equity reveal themselves through the amount of control and information that an investor has, through the rights that they have, and through the mechanism by which they receive a return. We've also started to get more involved in convertible debt structures, which we'll talk about a little bit also. I bring this up at this point here not to say do one or the other, but to know that if an entrepreneur has an opportunity and there's a deal on the table, it could be a great company, but a crummy deal and deal structure. And it's a lot easier to fix deal structure than it is to fix company. So we're hopeful, and we usually have a terrific experience when we're talking to entrepreneurs, and we try to create opportunities to improve the deal and make it more likely that additional investors will be brought in, and more likely that the company will be in good shape to invest in later. So there are a number of handouts on everyone's table here. There is the NVCA standard term sheet. NVCA is a National Venture Capital Association. They have a model term sheet. You'll see there are several flavors for different categories, meaning on anti-dilution, for example. You can go with option 1, weighted average. You could go with option 2, full ratchet. There are certain norms that are, I'd say, standard or more standard, but that gives you a sense of essentially where the levers are in a standard deal structure to make a deal have a greater or less return potentially, take away control or provisions. But what it does is it does it in the construct of that document, which all deal lawyers know and understand, and all VCs are generally comfortable investing in. So we like that document a lot. Our equity deals, even though they're seed deals, not Series A, are based on that NVCA document. There's also a model convertible note document in there, as well as a SAFE. A SAFE is something that we don't do. So this is basically a short document which talks about how equity will be granted later. It doesn't typically have the inducements we hope to see. It doesn't typically have the oversight and control we like to see, but it is a trend. More of them are being seen nationally on the coast, and we thought it was a good thing to be aware of. There's also a glossary of terms there as well. So we wanted to make sure we're clear up front that the types of deals and terms that we're talking about are early stage, seed stage. At different levels of the continuum, there are very different markets, very different approaches and funding vehicles. We're talking specifically about the seed stage, which, as we tend to see it in Northeast Ohio, is anywhere from post-idea, when there's something in a MVP, minimum viable product type state. Oftentimes it's being used or tested. There may be early revenue, but typically you don't see 20 employees at a company that we would fund or seed stage investors would fund. It'd be unusual to see more than $1 million of revenue in that type of company. So to level set the type of opportunity, we're going to be talking about deal terms at the seed level. So we're going to do a short video. I don't know if there are any Mel Brooks fans out here, but this is the first opportunity we've had to show this, and this is from the history of the world.
It worked before.
It's like a bad Verizon commercial.
Hear me! Oh, hear me! All pay heed! The Lord Jehovah has given unto you these 10 commandments for all to obey.
So many truths to unpack there. The reason we bring it, though, is that these deals seem like they're written in stone at the beginning, right? You go through this process. In any kind of equity deal, it seems like you have 200 to 300 pages of documents, certificates, purchase agreements, you name it. There's a lot there. And it's all the letter of the law until it's not, right? Any certificate of incorporation is amended regularly. Any right that you have can be given up. And even though we have a lot of control in many of our deals, in reality, we have to give up control later on as new investors come on board. Sometimes if a company struggles, there's less negotiating ability that we all have. The only protection really to keeping your rights is a company performing top-notch all the time, competing term sheets for the next round, where there isn't an opportunity to dig in and adjust some of the preferences. So it's an important thing to note that the deals that we work hard at don't always stay. And we saw an example of this recently where there's a deal that we've been in for 9 years, where the next financing round will take all these different types of preferred shares and put them into one junior preferred. So multiple venture capital rounds, tens of millions of dollars, years and years later, and there's still an adjustment. It's actually not a bad idea and concept for where the company's going and how they're approaching it. We have to approve it, but we're in a position where we're given a pretty good nudge to approve it. Might need help going forward.
People, hear me! Oh, hear me! Oh!
There we go. So even though they all, these deals are temporary, they can outlast the teams, they can outlast the investors, and it's a kind of a classic contract, right, that you hope not to have to look at the term sheet, you have to not look at the deal structure all the time, but you want it there for when you need it, and especially in harder times going forward, the foundation you stand on is really only as solid as the deal structure that you talked about and you put in writing. What that drives to is a limited set of outcomes. Either we do well or we don't, and either the company does well or perhaps they don't. Those two do not always intersect, though. There are plenty of situations where investors do okay, generally not great, when the founders and other management don't do well. There are plenty of occasions where founders and management do terrifically well and the early investors get creamed. We've all seen this plenty of times, right, where a company doesn't perform, there's a recap, a down round, a cram down. There are a lot of ways to say it, but when you lose your rights and you get diluted on a dollar basis, it really diminishes the potential for return. So we in our portfolio have companies that we think will do very well as a company will drive to an exit where we won't see a meaningful return. You really need the intersection of companies doing well and deal terms holding to do well. The 3 exits that we have to date are all in this general category. This is a little bit of a exercise and far from scientific, but we put it up there to say that not all deals have the same level of return to us as investors, and not all deals have the same level of return to founders. And this level of alignment, of having a deal structure where both sides can do really well, is a key part of getting on the same page and increasing your odds of being successful. So, has everybody seen Shark Tank, I'm guessing? It is, depending on the moment, exactly the way this whole thing works, and nothing like the way this whole thing works. Usually the latter, sometimes the former. One of the ways it's not is that it takes 5 minutes to come up with a deal, somebody gets creative, 3 people come on board, a company's funded. Terrific. In reality, it's different. And in Northeast Ohio and the Midwest, it's not unusual to have 10, 20, we've seen cap tables with 100 individual investors on it before, right? You can't have that many cooks in the kitchen, you can't have that many people driving deals and deal terms. There has to be a structure, there has to be a process for that to work. But when most investors are writing relatively small checks, perhaps $25,000, you really do need a village in order to fund a company at the $1 million or $2 million level at the seed stage. So this is a really high-level summary of just what happens at the discussion level, at the term sheet level, and at the document level. Nothing at the discussion level, nothing even at the term sheet level, signed term sheet level, is binding. Really, there can be a quiet period which is binding, but if for whatever reason the investor's diligence doesn't pan out, they can walk away, and there are a lot of cases where the founder can walk away too. It's really a memorandum of understanding of the deal structure you're working to get towards yourself. It's easy and it's fast and it's cheap to do the first 2 steps, Depending on a lot of things, it could cost $5,000, $10,000, $15,000 to do a deal in a deal structure. Part of that depends on how much hair there is on the deal in the first place and how creative the investors and the groups are trying to be. So real simple scenario, and this will probably bore some people in the room who are deal junkies, but we wanted to put one scenario together to have in mind for some of the panel discussions later. So in this scenario, we're just looking at ownership of a company where let's assume that there are three founders, three co-founders of a company. They used to own 100% together. They own 33% individually. If it's a $3 million valuation, which is not uncommon for an early stage deal, they raise $1 million, which is not uncommon for an early stage deal. The new investors get 25% of the company. The founders are left with 75%. But all these deal structures will have an option pool. And as part of the option pool, anywhere from 8 to 15% of the post money becomes available to incentivize the non-founder, typically, team to create alignment, and that comes entirely out of the pockets of the founders. So in this particular case, the founders go from 75% to 60% simply with the option pool. Now, like all medicine, sometimes you give it, sometimes you take it. In subsequent rounds, we are all diluted by each subsequent issuance or increase of the option pool. It always comes out of existing investors. So that's partly why investors are very incentivized to have a substantive option pool early and maybe aren't quite as generous later. The last scenario here just looks at that initial $3 million, then having a $3 million Series A later at an $8 million valuation. Just giving you a sense of how the dilution works, how over time the pie does get smaller, so the deal structures that are in place have to be thoughtful about where the deal is going to end up, what level of ownership the founders are ultimately going to have, and whether or not that's enough to incentivize them and to work for us as investors to see a return. So it looks like in the translation here, what we've lost is the United States, which would be this shape right here. I haven't checked the news today, but hopefully there's nothing going on. The point of the slide, though, is that where we are matters, and we're not on an island, but we can't exactly think and behave like we're in an area with hundreds of billions or tens of billions of dollars of institutional venture capital, with ecosystems coming out of Apple and Google and other large companies, with angel investors and Starbucks doing deals. It's just different. There are some national trends which prevail. There are some early seed national terms that prevail and make a lot of sense. But it's helpful to think about the ecosystem we're in, because if a company in our portfolio does well and then goes out for venture capital funding, they have a different ecosystem they're going out to than if a company in Northern California does well and they go out for venture capital funding. So the company has to be run a little bit differently, has to be managed a little bit differently in order to succeed in that environment. So these are the 50 investments that we've made North Coast Angel Fund over the last 10 years. When we looked at what deal structures we used, what we found is that initially, on our first investment, we never used convertible notes in the first fund. In the second fund, we did 2. The third fund, we've done 4. So there's a little bit of a trend in the earlier stage world to do notes, which have advantages and disadvantages, which we'll talk about a little bit later tonight. But the notes that we do as a fund, I'd say, are a little more buttoned up and probably a little less friendly to entrepreneurs, just in that there's governance associated with them that's not associated with most convertible notes, and there's a valuation cap. Some people would say that's a de facto valuation. Some would say it's a hint at what future valuation would be. Whatever your philosophy on it, though, as investors, we philosophically want to know what we're buying. We want to know what we're investing in, and we found that capped notes are a good way of getting the best of both worlds. This just shows initial investments. If this slide also showed follow-on investments, it would look very different, because many of our companies will raise a bridge round between the initial seed round and then a larger round or a venture capital round in the future. So this is something from CB Insights showing the 1,000 seed financings in a year and how many progressed to the next round of funding. What it shows is about half the companies don't make it to the next round. And the takeaway that we have from this is that the financing should be optimized to increase the likelihood of getting to that next step, not necessarily the likelihood of what would happen in a perfect situation 6 years from now if everything goes well. And the way that translates into deal terms is by one, making sure you raise enough money, because one of the first deal terms is how much money is the company going to raise, making sure it's at an attractive enough valuation and structure so that the company can raise as much money as they would like, and then having a clean structure that subsequent investors can get involved with down the road. In another bit of data that CB Insights put out, they did a series of after-action reviews or post-mortems with startups trying to understand why they failed. Interestingly, running out of money was the number 2 reason why they failed. And part of what that tells us, again, is optimize the likelihood of getting to that next round. And the things I mentioned are part of the way you can minimize financing risk as opposed to product risk, market risk, and some of the other risks that we tend to take on. So with that, we're going to invite our first panel up. We'll go through and ask them each to give a brief introduction. So please come up, panel number 1. They have been prepped and asked to give very clean, precise answers, targeting 30 to 45 seconds. We're asking that the questions are also relatively short, and that there is a time left for everyone to ask questions from the audience. So please do think about what you might want to ask these group, and I would say no one here is going to be offended or thrown back by any question. Maybe they'll surprise us.
Maybe.
Don't mind just telling a little bit about yourself, Jon.
I'm Jon Grim, and I work at Jumpstart, senior venture partner there. I work with all the folks at that back table on the left. One of those guys back there is probably more qualified. Maybe all of them are more qualified than I to be up here, but I'm glad they're here tonight. Is that enough?
Perfect.
Hi, my name is Mike Makofsky. I'm an attorney at McCarthy Levitt, Crystal and Liffman. Our firm is a Innovation Council member for NCAF. My work is primarily M&A, finance, and private equity.
Chris McKenna, and my firm is Carlton McKenna & Company. We do investment banking, and we help raise money for growth stage companies and sell later stage companies usually. And I'm a North Coast angel investor for half a dozen or so years, and also do angel investing outside of the fund as well.
Terrific. Well, we'll start with Mike here and throw a little bit of a softball. And just help us understand, as you're looking at company structure from the beginning, should these companies raising money at the seed round be looking to structure as an LLC or a C Corp? And does that really impact what terms will come?
So I think that for angel investors and then VCs and eventually...
Switch over here.
Sorry.
Is that mic working?
Is that better? There. Okay. So for angel investors, VCs, and eventually private equity groups, I think the preferred structure is for a company to be a corporation and to be formed in Delaware. And the reason I say that is because Delaware has the most developed body of corporate law out there, and it's the most sort of understood and most respected. So regardless of where the company is or the investors are, there's a comfort in knowing what the Delaware law is. With that being said, it's not fatal by any stretch if a company isn't a Delaware corporation. We've had plenty of companies get investments, if they're Ohio-based or other states. And even if an investor is requiring the company to be a Delaware corporation, there are ways to accomplish that. you can convert to a Delaware company, there you can form a new company, merge into it. So I guess my takeaway would be, if a company's able to think about it at the beginning, to definitely keep that in mind, but that if they're not a Delaware corp, there's still ways to get there.
Great. And Chris, mentioned before that some of these deals have a little bit of hair on them. What does that mean to you, and what should people expect to see if an opportunity they're presented with comes with a caveat that there might be some hair on it?
Yeah. So I think the easiest way to think about that is that when you look at a deal and a description of confidential information, memorandum, something, there's a section that talks about risk factors, and that's a good way to encapsulate what those are. And so those are, customer concentration, or maybe there might be turnover in management, or cap table sorts of issues, or any of the normal commercial stuff. And a lot of the risk really, of course, is within the company itself and what their business model is, adoption rate, all that sort of stuff. IP, who holds it? That's what I think of as hair.
And then, John, with your personal investor hat on, are there filters that you use on deal and deal structure? Are there red flags right up front that you'll say, this deal is or isn't for me based on structure, terms?
I generally don't look at structure as a first priority. I look at the company, the team, the market, the basics of everything that people are trying to go after. Terms come into play a little bit later. If you have sophisticated founding team that's been through this before, they know the game, and they can come up with a term sheet that's fairly effective. And in that case, I'll take a parallel look at that while I'm looking at the company. But if they're not sophisticated and haven't been through the ringer before, I tend to push the deal terms back off.
And then, John, just staying with you, some deals are led by the company. The de facto is that they have a piece of paper that's been developed. Sometimes they're looking for an investor lead. What is your take on, not necessarily what you prefer to see, but what your read is when you see an opportunity presented that's either from a private investor leading the round or paper that's been developed by the company?
Skeptical all the way around. If I see if somebody wants to force something up front, we were just talking about something that has recently happened at Jumpstart. An opportunity came to us that Hardwick's involved in, and it was a $10 million deal on a company that really hasn't done it, a $10 million pre-valuation on a company that really hasn't done much yet. And that's kind of like, it's like, guys, either reconsider or we're stopping right now and we're not going to waste anybody's time. What was the other part of the question?
I think you got it.
Oh, yeah, okay, good.
So we'll go with Mike. You deal with clients who are raising capital, clients who are investing in companies. When do you recommend convertible debt versus equity?
So I think that preferred equity is the most common approach. I don't know if people are familiar with, it's called the Halo report, but I think it says something like 2/3 of all angel investments are preferred equity, which makes sense because of all the protections that are built in. I think convertible debt can be an option if either the sort of evaluation, parties can't agree on it, or maybe it's complicated, or it can't quite be figured out yet. So the debt may make sense in that case where, within a year, that they expect to, have that growth or be able to set that valuation. So in that context, it may make sense. But you obviously have to be careful with it, right? Because it's debt now. So if you can't get to that next raise, you know, the debt will convert into equity, usually at a discount. And so, if you have that raise, it will convert. If you can't raise that money, then you have debt that is due, and it's usually within a 12-month period. And so, if you can't pay that, then that obviously is going to create issues for the company. So, it can make sense, but obviously, it's something that has to be considered closely.
Great. And then, Chris, as you're structuring these deals, masterminding the deals, to what extent are you thinking about upfront, this is a VC path deal, or this is a deal that's likely to be angels all the way, and driving some of the terms accordingly?
Yeah, it definitely matters. I mean, I think on average, most entrepreneurs would be well served to be thinking, even from the beginning, how quickly and how can we most efficiently get to be cash flow positive, or have a path that's close there, so that we have an option to not take the next round, right? So that you're always in the best position when you're able to say, look, we don't need this, but we're going to do this with this. I would say often entrepreneurs are thinking about the next round kind of in the same bucket as revenue, and that's a bad place to be, and you end up in all sorts of tough spots. But I would say, you know, whether it's going to be it's hard to imagine a company that really should appropriately only ever have angel investment, unless it's just the kind of the first couple of rounds, and then they generate their own cash. So I think early on, you always want to be set up and, you know, use a reputable attorney so that your documents don't need to be, you know, rewritten. You want to kind of set it up for success from the beginning. It's definitely worth an extra couple of bucks to make sure you get somebody who's done it before.
Great. And so, Mike, despite all these nice people in the room, is it possible to have too many angel investors in a deal? And if so, should you set up a special purpose vehicle, get people in an LLC, and try to contain that group?
Well, like the sort of your chart showed, I mean, I think at a certain point, if you have so many investors that you've got all these voices and all these demands, and it impinges on the company's, you know, operations and how they you know can work, that can become an issue. So the idea of forming special purpose vehicles for the investment does make sense. So instead of having, you know, 20, like 1% owners, you can have, you know, one entity that owns 20%, and that definitely cleans up the, you know, the cap table and makes it, you know, much more manageable. But there's obviously pros and cons to that too. For the company and for the investors, actually. So again, instead of being a 1% owner, you're part of a group that owns 20% now. That gives you more leverage with the company. You have more say in it, and so that could be persuasive. You know, for the company, again, you're only dealing with one entity now, but it's an entity that's 20%, so that can cut both ways as well. And for the individual, having that leverage may be nice, but it does add a layer of complexity, because you're not invested in the company anymore. You're invested in an entity, which then is invested in the company. So there's documentation involved. You know, you got to work out your deal with your other members, and someone's probably going to manage the group. So you may give up some of your individual rights for sort of the collective, you know, leverage. So that's something that has to be, you know, taken into consideration as well.
Okay. I'll throw another comment in there on that. If you're an entrepreneur out there, the last thing you want to be doing is herding 20 cats and having one of those 1% owners, you know, throwing a wrench into your day every day by calling you and asking you questions and demanding information, and it can get very problematic and very time consuming. So the idea of going into an entity as Micah suggested, is a very good one.
Great. This will be the last question for me for this panel, so we'll turn it over to questions from the audience. But Jon, the whole idea of startup financing has kind of been romanticized in terms of partnerships and entrepreneur-friendly and early-stage investors who are successful entrepreneurs and get entrepreneurs, and it kind of makes it sound like everybody's happy. How important is it that the CEO, the investor, that everybody's happy, fully satisfied, really got what they wanted at the end of an investment round?
Happy is a bad word. Satisfied is a really good word. If anybody is too happy, it tends to be a lopsided deal, and someone down the road will probably not be happy. But if everybody is just satisfied and they're like, okay, that generally means it's a fair deal. And the fair deals are the ones you want to cut, because then there's skin both ways. If management feels like they got a great deal from maybe a non-sophisticated investor, that investor will likely not go with you into the next round, could create problems for you. They don't understand things. If the investors are too happy, my guess is the incentives for the management team would run out a lot quicker. So, and a lot of that has to do with valuation and that kind of stuff.
Great. Questions from the group?
So I call early stage ex-friends and family rounds. And there's a lot of accredited investors out there. Just because you have money doesn't make you sophisticated. How important is it for the angel investors to understand, or to what extent should they understand the deal, the risks, all those sorts of things?
You guys want to take that, or I'm not taking it?
Just one quick, I always think about angel investing as just as the same but smaller for larger rounds, and larger rounds have lots of documentation. Going public has lots of documentation, description of risk, all that sort of stuff. So it's critical for somebody investing in a company to read all that stuff, even though it's long. First of all, it's critical that the company has it to protect themselves, really, that they've disclosed all the risks and all of the, for what they knew at the time, what's going on with the company and what could happen. So I think it's critical that they know, this is risky. Look at that. We saw the chart earlier of how many companies don't make it to the next round, and on the North Coast chart, how many have died. That's the way it is. This is really risky investment. So everyone should go ahead and say, okay, everyone raise your hand. Acknowledge that most of the time when you put money in these deals, you're going to lose all of it. We all good? Okay.
Other questions? Wait.
When I talk to a lot of entrepreneurs, they always struggle with ownership, the founder ownership, and the percentage of it, and it all depends on the first round when you do the valuation, and valuation is always difficult. So, and also they always like to set up a pool for options for the board of advisors, the employees, and others. Is there any rule of thumb that you see that kind of works, that the fund that should put in the mind that what kind of ownership should they retain, when they start looking at the investment funding?
So is there a baseline level of ownership that a founder or a founding team needs to stay in the game?
Right.
I'll start. I had a discussion with a client today on this exact subject. Excuse me. It's like, where do we start? How do we raise money for our, thinking about our Series A? And I was telling him, a good target is to hold the first investment. You got to figure out how much money you need, right? That's the first thing. and then think about what you want the first round investor to get percentage-wise, and then you kind of back into the valuation, and does that make any sense? And I'm seeing through PitchBook and many other sources that we use at Jumpstart that the first round investors, a good target is to let them in at 20 to 25%. But that's just a generalization. I mean, when we did our first deal at Notice, several of the venture capital people wanted 35% of the business. And we ultimately didn't do it because we felt that was too high. But there's so many different circumstances that can go on. And it depends really where the company is, are they really generating revenue? There's so many things that can influence that. So you got to take it all into account. Anybody else?
One more question. We'll get two. I saw that hand.
How much focus is put on management compensation pre-deal? And have you had any problems with that compensation accelerating as the company starts to take off? Being a minority shareholder, what do you do?
Are you saying that compensation is the key driver?
Well, if you're managing a business, if you're,
Well-
I take as much money out of my company as I can.
Well, if you
I'm
are,
just being honest.
what kind of business do you have?
Insurance.
Okay, that's different than a startup early stage technology business that's got the potential to scale. So if your end game is to scale and create value, you'd rather see the money going into driving the company with the rewards on the back end, i.e. through your equity opportunities or other forms of participation. But we at Jumpstart, and same thing at North Coast, I'm sure, is that sometimes companies come in and the entrepreneurs are asking for salaries that are going to drain the cash out of the company really quickly, and they only have 6 months of runway, and you're like, this isn't going to work because we need 18 months of runway. How are we going to get around this? Raise more money? Does that make sense? Often not. Or lower your salaries until you can prove that the company is doing well, i.e. perform, show us you can perform, and then we can raise your salary, or offer other forms of compensation in terms of equity and other stuff like that.
That's the crux of my question. So all these discussions are taking place while the deal is being negotiated?
While the deal's being negotiated, and then subsequently to the deal.
Okay.
If you invest in a company and it's running out of money too quickly, and you can't hit milestones that would attract the next round of money in, then you're going to be going to your entrepreneurs and other places on your P&L and saying, where can we lower some costs to extend our runway so we can still hit those milestones?
And we won't steal too much thunder from the governance panel later, but once you're into these companies, the board of directors ultimately has to approve changes in budget and salaries, and in many cases there's a compensation committee which is charged specifically with compensating the CEO and approving the compensation levels of the senior management. Mark?
That was exactly my question.
Okay. Amy?
I wonder, you mentioned safes very quickly. I wonder if anybody on the panel would put a little more meat around, do you like them? Why do you like them? Why do you not like them? Could we cover that in a little more detail?
Okay, so the safe agreement, I see Peter has a hand there.
The safes really don't belong in this market, in my feeling. They're for the billion-dollar incubators out in Palo Alto, and it's basically a way for them to throw $10,000 or $50,000 at a whole bunch of stuff and see what sticks without a promise to pay back. And then if they convert if there's a next round. But for the investor side here, you want to run from those.
We don't see too many safes around here at all. They're designed to protect the entrepreneurs, for a large part. And I think the Midwest, for better or for worse, is probably fair in treating entrepreneurs. I'm not saying the coasts aren't; it's just a different ballgame. But the safe deals aren't really needed because we have rather satisfying deals around here.
Oh, please. Based on that, assuming everyone is satisfied with the panel, please join me in thanking them, and we'll welcome panel number 2.
Mr. Rome, how are you? Good to see you.
No, I'm helping he's bachelor number 3.
So we have a couple people pulling double duty here. We won't make you introduce yourself again, but Peter, why don't you give us a quick background?
Hi, I'm not John or Chris. I'm Peter Rome. I'm chair of the business department at Ulmer Byrne. Work with funds, accelerators, angels, entrepreneurs, and emerging businesses, actually some large businesses on all sides, from helping them strategic plan, acquire, grow, finance, do business with others, attract and retain the best and the brightest, create brands and barriers to entry, plan for the exit, and exit that whole life cycle of a business. And we're just talking about one piece of that life cycle today.
Great. And so, John, earlier you mentioned in your work at Jumpstart, you saw a deal which sounded pre-traction, maybe pre-product, that had a $10 million valuation. So valuation is one of those things that is an indication of what the entrepreneur expects, and it's a step to a future financing. So do you always run for the hills when you see a valuation that feels that out of market? Is there a range you'll consider, or do you say, I'll sit down with any entrepreneur and try to talk to them and see either if a higher valuation is warranted or if they're open to a different structure?
I don't run for the hills because I can't run. I would generally sit down with an entrepreneur or a founder and try to talk sense into them as to why high valuations don't make sense for future rounds in the company, because they can really be difficult if the company doesn't perform. You don't want them you try to teach them, you don't want them too low because then you're hurting yourself. You want them too high because then they can hurt the next round if there's poor performance or even mediocre performance. So, and if they don't want to listen, or they're just, they shut you out, that's a pretty good indication that you may not want to work with them. But if they're willing to consider it and begrudgingly move on their position, that's a good sign. So.
And Chris, as a banker, when you're helping entrepreneurs raise capital, you're on their side, you want them to do well, you need them to be successful, but you also need there to be a reasonable market for what the security you're trying to sell.
Yeah.
So how do those conversations go?
Yeah, so, I would say that if you run into someone like John who can help you, that's super helpful. For us, so I guess two answers. One, for us as a firm, all we do is sell our time and our energy and all that. So if someone has an outsized expectation, we talk to the entrepreneur about it, but by and large, that's a real red flag, honestly, because, it's not our job to change their worldview about whether or not the fact that they have a much better model than Facebook. And a lot of people kind of come in and their baby is so beautiful. And I will say it's probably 2x that once you get, this is not necessarily for the stage, but individuals, if you're trying to get angels to invest and you're, talking about, all the problems with the Facebook model, you're asking people who have, $25,000 to $250,000 to invest, and you need to catch their interest and et cetera, and you're not going to catch it with a $10 million valuation and no revenue. And people are not going to take, some people are like, well, let's ask high, they'll come back. They won't. People do not have time, nor do they have an interest to beat you down to where they'd be comfortable. They are going to walk away and you'll never hear from them again.
So
I was going to add something to that.
Yeah.
If you are an entrepreneur, the exception to this is if you're an entrepreneur that has exhibited fairly extreme success maybe once, twice, 3 times, and you walk into a room and said, I want a $10 million valuation, I've only got an idea, but you've done it before, you could get it, but that is the exception to the rule.
And so, Peter, we'll dive into the weeds here on terms. What is market today for equity? All right, so for preferred equity, what should people expect as far as liquidation preference, participation, dividends, all the goodies that we look for as investors?
So I'm going to pick right up where John left off, because it depends who's asking, right? If it's, Jeff and Randy who've had massive exits and are doing something quite similar, they're going to attract a participating preferred with maybe a one-time liquidation value and maybe a 5%, cumulative dividend. If it's, me starting a company because I have an idea and I'm lucky enough to get it funded, it may be a 2x and 8%. It's market is in the eyes of negotiation of who's asking and where the money's coming from. If these were bigger deals later on, the VCs have much more leverage. But for these purposes, somewhere between 5 and 8%, depending on who's asking, and usually participating at one-off, but it might be more depending on who's got the leverage. Excuse me, on the preference.
Okay. And John, in our conversations with entrepreneurs, I think we find that they don't often overtly consider the amount of money they're seeking to raise to be one of the terms, right? It's oftentimes a combination of how much they think they need and how much they think they can raise. And oftentimes they'll lower that amount just to make it more realistic or maybe increase the likelihood of getting there. So how do you think about the target of how much money needs to be raised in the context of the overall deal and structure?
I like to look at the overall picture, like a 5-year pro forma. No pro forma is ever right. They're just directionally right. And then I like to try to figure out, is this anywhere close to what they're going to need, or are they going to need 3 times as much as they think? And then try to slice that up into the different rounds. And this is all theoretical, but and then to try to determine the right amount for each round. That amount being enough runway to get you to milestones, to get you to the next round, but also not so much money that you're going to be diluting the founders down too much where they're not incented anymore. In each of those rounds, those apply each round. So if you're really up on like Series C and D and E, I don't think it matters as much because you're probably doing pretty good if you're still attracting money at that stage. And even a small piece of the business is probably going to return a fairly nice reward.
Just one other piece on that is, people sometimes get too hung up on percentage ownership, whereas if the pie is growing, you shouldn't be raising money unless you think that additional money is going to increase the dollar value of your percentage interest, whatever it is. So, I think entrepreneurs sometimes get a little bit caught up like, geez, I don't want to get down to 40% of this round. And if you're bringing capital from a partner or a VC, someone who can really help you grow so that the dollar value of what it is you own is going to increase significantly, we encourage our clients to focus on that, not necessarily the percentage. So dilution becomes a scary word, like, we're going to get diluted. Another way to look at it, we have a partner that's really going to help us get to where we want to go.
So Chris, hearing you describe that, it sounds like you're part investment banker, part therapist, in terms of managing the expectations and the emotionality of this, right? Because it's highs and lows, and some days it looks like it's going to work out really well, and other days it doesn't. So how do you manage the emotionality of that, and how do you recommend that we as investors, when someone like you isn't in the middle, how we think about what it really means to the entrepreneur, whereas for us it's one of a lot of opportunities, but for them it's their deal.
Right. Well, I think that's maybe, you put that in the category of opportunities or risk factors or something, because, you know, you're investing in usually one or two people that are going to take your capital and make something happen or not, right? And most of the time not, and so that's a big deal, is how high and low are they? And are they able to kind of realistically look at either valuation or how they spend the money? And, you know, this is your partner. So, you know, I think how they handle that, and it's emotional. This is the most important thing to them. So, and you want them emotionally invested, but, you know, to what degree and how high it makes them and how low is, you know, I think that's something to watch out for. So.
And Peter, you work with a lot of early stage entrepreneurs to raise capital. What do you advise them around option pools? How big should it be? How long should it last? How should they think about that as a resource to the overall deal?
You know, the whole idea is to attract and maintain and retain the best and the brightest. Typically, you see as little as 8%, maybe as much as 15%, sometimes higher. But mostly it's in the 12 to 15% range. And you want to give enough, have enough there that you can really outgrow your founders when you need to upgrade, because what it takes to get something off the ground is not necessarily what it takes to run a business later on. And you need to have the power there to attract the next guys in.
And then just one specific term, Peter, the anti-dilution protection. Is that a thing anymore? Meaning, are any deals anything other than kind of a standard weighted?
Not so much, it's weighted average. By the way, you try and get away with it on the founder side with just preemptive rights.
Right.
So you want to pay to play, great, but if there's a down round, you know, too bad.
Yep. And Peter, you're someone who has, we'll just keep going.
Yeah.
So you're somebody who has a great network, you're involved with a lot of people who invest in early stage companies. What economics do you need to see? What kind of potential do you need to see to activate that network, right? To pick up the phone and say, this is the kind of deal you need to take a look at.
I get that question a lot. I think it's kind of like Potter Stewart's definition of pornography. I know it when I see it, right? It really goes back to who the founders are and how big is the addressable market, and, you know, who the competition is, and is somebody way smarter than I am able to diligence the technology, and kind of you mix all that together, and if the hair on the back of your neck stands up, you know, you go with it. But there's not one, you know, hard and fast rule that I have. I don't know if you guys are any different.
And then one more question for Chris, and we'll open it up to the group. So, Chris, you, from a banker's perspective, you obviously want clients,
Yeah.
right? But you don't want all the clients.
Right. Yeah.
How do you filter and just think about for which entrepreneurs you can really help them be successful, and for which entrepreneurs it's probably just not a great fit?
Yeah. So, I mean, for sure, getting an investment banker is not the right answer for everybody, and within that, we're not the right investment banker. But usually there needs to be an opportunity for us to work with a company on the current round and the next round. And that means that there's, you know, this stage round, which is, you know, $1 million. We can help with advice and cheerleading and introductions, usually not as much of an engagement for us, and with the understanding that in the next round we'd be involved. And so part of that is the entrepreneur, you know, kind of mature enough, forward-thinking enough to be able to say, okay, I get it, this is what I want in this round, this is what I need in the next round, and this is, you know, how we think about our valuation. So there needs to be, and it works best, as these guys said, about if someone's done it before, that helps a lot, because they've stubbed their toe enough and recognize that, you know, dilution's not necessarily bad. All those things that come with a little bit of miles under the car. So
Great. Questions from the audience? Paul?
I want to talk about the options pool. Are there any standards for percentage of that go to different
So there's a tech company we're with right now that just brought in a president. I don't know what they gave him, but just kind of curious, like what is a title like that, or a C-suite versus a VP of marketing or sales? I mean,
You know, so it kind of depends on who you're talking about, but rule of thumb, maybe 4 to 6% for a CEO, and 2 to 3% for a CFO, COO kind of person, and on down beyond that. But I've seen as much as 8% with a 2% kicker for a CEO. But that's in a company where he's had an exit before, grew it to $250 million, and had big exit. And to get him interested, that's what you had to do, and it was well worth it.
Paul, just to kind of go further, if the founding team, they've got all the equity, it tends to be a little bit different than if you're bringing people in from the outside that were not founders into these positions. Founders often carry a higher level of equity than people you're bringing in as a hired gun to run the company or do something. But there are other comp mechanisms at the end of the day, the deal day, so to speak, that can really buffer up their compensation, even in lieu of not holding a tremendous amount of equity. Just letting you hold it.
Other questions? Economics of the deal? Yes?
Do you, and if you do, how do you monetize sweat equity?
The question is how you monetize sweat equity.
If you do.
I think the idea of sweat equity is what's the valuation of the business. So, using Todd's example earlier, the company's value is $3 million, you're putting in $1 million. The sweat equity, all the brain power, nights, weekends, whatever you've done to get to that point, you need to put a number on it. And that's the valuation of the company. That's kind of how I think of it.
And often that's reflected in the founder's equity coming into the deal, because they're putting that sweat equity maybe even before an investor comes in. They've raised money from friends, family, and fools, and their sweat equity's going in there. They're not taking big salaries, and so they're taking a fairly large chunk of the equity, up front to get that done. And when they raise their first money from an institutional investor, they've got a decent size of the company, so it can be already reflected in the cap table.
Are you asking kind of go forward, like instead of cash compensation, or?
I'm thinking when there's an event in which there's going to be waterfall, do they get some type of, past compensation before the angels or the VCs came in?
Yeah, I mean, there could be if you have maybe what John was referring to before might be a sale bonus. So you have somebody who's a president who got X%, but they're going to be integrally involved in not only the process of selling, but maybe thereafter. So either stay bonus, sale bonus, something along those lines.
Well, one thing that didn't come up, Peter, I'll throw this at you, is reverse vesting. Do you mind just sharing with the group what that is and when
Sort of you
it's
vest,
appropriate?
you would vest into your incentive comp units, and then after a certain period of time, vest back out. Don't usually see that if it's the type of entity where it's one for all for one, and it's like a project that's going to go on. But we do use it where, like for an accelerator, it's people that work in an accelerator, where there's little distinct projects, and I may work on these handful while I'm there, but each one will either exit or be washed out in I think 3 or 4 or 5 years. You may vest people out after sort of the tail end of whenever their projects that they've added to value or not are over, in order to properly incent those that create value later. But it's not that common.
Okay. One way we've used it is with founding teams that have 2 or more members, where the, say, 60% that's left over is divided amongst 3 people, right? And you don't know if 3 people are going to be there for 8 years or for 8 weeks. And it's hard psychologically to say this ownership that you have, you don't really have it. And what we've done, though, is say 50% of the ownership that the individual has is there and it's earned and can't be taken away, but the other 50% is essentially vested back to them over a period of years. And the idea is that it rewards the people who stick around and preserves equity in case some don't. And the way we've seen founders get comfortable with that is when it either would accrue solely to the other founders, right? It's not a ploy for us as investors to have a higher ownership position, or if it's the CEO that ends up going, then that would be utilized to incent the new CEO. Any other questions before panel number 3? Okay, well, thank you very much. We have 3 fresh faces here. We're noting that the bar and the food continues to be open, so please feel free. We'll ask the new panel to introduce themselves.
Yeah, hi, I'm Rem Harris. I'm with Jumpstart on the investing team there. I've been investing for Jumpstart for about 11 years now.
Good evening, I'm Michael Ellis. I'm a corporate attorney with Buckingham Doolittle. I practice mostly in the venture capital area and mergers and acquisition. And I've drunk the Northeast Ohio Kool-Aid. I'm an investor in both North Coast 1, 2, 3 and the venture fund.
Hello, I'm Brendon Anderson. I started off as a founder and operator of some small businesses. Have transitioned probably over the last 15 years to mostly be investors. I've been an investor through a formal fund called Evolution Capital. We invest in typically businesses that may be a little bit larger and to really kind of focus on the scaling side.
So Rem, we'll start with you. Oftentimes founders want to retain control and they'll mention control. How do you balance the desire for an entrepreneur to have control of the company, yet for there to be appropriate balance and governance with the investors?
In 30 to 45 seconds?
Please.
Really? Okay, so complicated question. I mean, everybody gets wanting control, and you want that as a founder, you want it as an investor. I think the first thing is something that a few members of the prior panels talked about. This is it's a trust-based relationship. Founders are going to give up certain control rights to their investors, and increasingly probably over time. So it's going to look different at the Series A and B rounds than it might at an angel round. Founders have to be comfortable knowing that investors will require certain types of rights from them, but they have to also trust that those rights would be used responsibly in a way that's constructive for the growth and ultimately the success of the company. Now, a very successful founder raising an angel or angel seed or Series A round may retain greater amounts of control, and that's warranted due to their prior experience and success running startups. So it is a balance. It is a give and take, and founders are going to keep some control provisions, and investors will take others for sure.
So Brendon, you mentioned that you invest at a little bit of a later stage. What do you expect to see governance-wise, process-wise in place when a company comes to you?
That's a great question. It's across the board, and it really, pardon Rem, Michael, if I venture down away from the VC world, just kind of kick me and I'll get back. I think back to when I first started kind of a business, and I would go to people that knew me, were kind of trying to help me, and they gave me a whole lot of control in those beginning days. And then as we would go and raise more capital, expectations would rise, and obviously so did the requirement to give up board seats in certain kind of restrictive covenants. And so I almost view it that as it gets closer to something that evolution would be interested in, that the expectations rise and it moves away from the person and more towards the entity.
Then Michael, speaking of board, what does it mean to be an independent director, and who gets to choose who is the independent director?
Well, the concept of independent director is what you want is someone with not a major equity stake in the position, not part of management. What you generally would like, your ideal independent director would be someone with industry experience. If you're a biotech firm, someone maybe in the pharma industry or who has taken other biomedical device companies public, someone who has experience in the market you intend to go with. So that's what you're looking for in the independent director. And what you generally do is say that the existing directors, both the founder and the investors' directors, basically have to agree on who this person should be.
Great. And Brendon, talk for a minute about protective provisions. And for those of you not familiar, protective provisions cover actions that are so important to a company's growth or continuity that preferred shareholders typically have to vote to approve them, majority or 60%. And there can be anywhere from 3 to 10 protective provisions. What's most important to you? What do you want to say at that level?
And just as a minority investor?
Yes.
Yeah, look, I'm probably trying to reduce it to probably too simple. I just wanted to be treated fairly. I want to know what's going on. I fundamentally don't want the ability to be forced to sell my shares unless there's a kind of an overall liquidity event. And those are probably the big ones to me, because I think when you go in that position, you know that there's other people that are going to be ultimately calling the shots. But to be informed and to effectively be treated like everybody else is my biggest requirements. And I'd love to get Michael and Rem's take on the other.
Well, again, when you're looking at it from the minority shareholder, the investors, you have to view it at the point that there may be $3 million of sweat equity, but your investor group is the one who's put in all of the money, the $1.5 million to get it further. And you want to protect that interest. So you want to make sure that if there's a sale of the company, that even though you may have a minority interest, that a majority of that minority ownership may have to approve the sale or make sure that it's been approved by your, director that you have elected from a group. So you're trying to protect yourself from those type of actions, not from the day-to-day management of the company, but from the fundamental decisions.
Yeah, not a lot to add. I just wouldn't want to, as an investor, you really need to protect your position on the cap table. So things that you don't want is for a founder to decide they're going to go out and issue a new class of stock, maybe at a lower price than you recently paid, or maybe they want to give dividends to stockholders or certain stockholders, or maybe they decide that they need to invest in a new McLaren for the company to drive around in, when that's not part of the budget. So there are a number of provisions that investors look for. It gets back to the types of controls that you want as an investor to assure that your position, being a check writer and not an operator, is protected.
And Ren, talk about side letters for a minute. So in addition to all of the terms we've talked about, all of the documents that they turn into, sometimes there's a little side letter between investors and the company. What is it, and is it appropriate at the seed stage?
Sure. So a side letter is an agreement separate from the investment documents that gives certain rights to the investors, or investor singular. And this could be information rights. It could be board observation rights. So they generally are not super challenging terms. They're not terribly unusual. We tend to have a side letter or a management rights letter when we invest. I guess where it becomes, it's a matter of really what's practical. So if I'm writing a $25,000 check, what type of side letter should I get, or should I get one, period? Versus an investor who's writing a $300,000, $400,000 check. It comes down to really what's practical. What rights do you feel that you need as an individual? Can those rights be provisioned to someone else on your behalf? Let's say North Coast Angel Fund representative that's on the board, or board observer. And can you get adequate information to inform you as an investor?
Great. And then, Michael, when you're one of many individual angel investors, years down the road, you like to know what's going on with a company, right? You like to know, are they doing well? Do they have money in the bank? Are revenues growing? What sort of information rights should all investors expect at the beginning to see in a term sheet that they're entitled to?
Well, again, whether it's Delaware law or Ohio, the statutes provide that you have a right to the annual financial statements. You have a right to look at the books and the minutes of the directors' meeting or the shareholders' meeting. Beyond that, it's contractual, okay? And you may not get interim financial statements. You may not be able to look at an operating budget. Again, one of the things you talked about earlier is to aggregate the number of individual investors into one single purpose entity, okay, that instead of you putting in 25,000, you have 10 people or 6 people putting 250, 300,000. So you are in the same level of a North Coast or sometimes a Jumpstart, and are able to get those management rights to the representative of that group.
So that ties into the next question for Rem here, the notion of major investors. We'll let you define about what is a major investor typically, and if you're not a major investor, what does that mean you're out in the cold for?
Yeah, so major investor is a defined term, and it's usually written a check of X amount or greater, and or cumulatively into a company. Trying to think of what I've seen as the lowest. Maybe it's 100,000, 200,000, a little bit more typical. And it becomes a demarcation point at which if you are defined as a major investor, you have certain rights that non-major or smaller investors do not enjoy. So it gets back to a matter of really what's practical for a company to perform and fulfill on the behalf of its obligations. Having a cap table with 20, 30, 50, 100 angels and trying to give them all similar information rights and access rights is very difficult and impractical to do. I think it's fair for companies to define a major investor at a certain point. Generally, we don't see that at the angel round. We tend to see it maybe at an A, maybe more typically at a B round. And that becomes really a way to manage the founder's time and how they are required to or not required to engage with each of the investors.
And Brendon, at the later stages, one of the things that major investors get, and sometimes others don't, is pro rata rights, the ability to invest in subsequent rounds. So on one hand, you want to be fair and open to everybody, and on the other hand, you're not one of the little guys in those later stage investments. So how do you approach pro rata rights?
Yeah, and when I saw the question in advance, I chuckled because it was something that was foreign to me. I mean, the concept of not getting the pro rata rights. I actually may prefer this one, just because I look at it and I think that at least as a class, not getting the pro rata rights would be, was not something that I'd be familiar with. So I want to pass that to the experts.
Again, you see the pro rata rights, and it is a function of the time of the company. You have a 0.05% shareholder, and you're raising $1 million. Does the company really want to spend the time chasing this person for a $5,000 or $1,000 investment because that's all that they have? They may only want to chase the larger investors. They may offer it to the other people, okay, just because, we're raising $1 million, our major shareholders are taking 650,000 of it. We're going to offer to existing shareholders the right for the other 350 before going to new shareholders. But there may be minimums of 25,000 or so, not the pro rata right, because as a company CEO, I don't really want to be taking in $2,000 checks.
So, a couple questions for anyone who wants them here. As I mentioned before, the idea sometimes you give the medicine, sometimes you take the medicine. One of the things that's hard for us sometimes is when larger investors come in, we have to give up some of our rights as well. We give up some of the control that we have. Sometimes that's giving up board seats. How does that practically work with an investor group that on one hand wants to see a company grow and be successful, but on the other has invested capital, has invested time, energy, and emotion into being part of the control group of a company, and now you're relegated a little bit to the sideline?
I'll take a crack at it. So obviously we see this happen, and I guess I generally like to be informed. I like to have access. I like to be involved with companies. However, that said, I know that as an investor, not just me, but our team at Jumpstart, we are really good at the earlier stages. We're not as good at the later stages. Doesn't mean that we're not useful or valuable, but from the companies that we've invested into, those that really take off and do extremely well, when they do bring in new boards, new investors, we see that they also bring new skill sets that are more relevant at, let's say, a growth stage. So I think, one, you have to be comfortable knowing that you may step aside and know that in the process that company is going to have a new team that's going to be surrounding them, helping them in a way that may be superior to what we could do. It doesn't mean that you can't keep informed. Some companies are open to having observers continue to join. You may not be on the board. Other companies, though, and we've seen this together, some companies.
Switch.
Some new. Is it me? Is it me? Okay. So some companies and new investors just don't want you around, and they will work hard to keep you excluded from the conversations.
Great. So we'll open it up to questions in just a moment here. And as we think about terms and think about governance, I think part of the lack of comfortability, and if people in the back can't hear, just shout or wave and we'll talk louder. Part of the desire for control on both sides is a little bit of a lack of trust, or maybe a slowly establishing trust together, right, as an investor group, as an investor and an entrepreneur. So whoever wants to take a cut at this, how does it typically evolve over time? Are people as focused on these control issues once you get into the trenches with each other? Or do those issues tend to dissipate and the focus is really on the company?
Can I bifurcate that question to, is a company performing well or is a company not performing well? Because depending upon the answer to that question will depend on the result of your element of trust.
Don't all, if all deals go according to plan, you're going to give up control, right? I mean, if any deal that you get into, if it goes the way you're planning to, you're going to give up control. And I guess you're right, though. So it's the ones that aren't going well. So ideally, I just got to sit and listen to a conversation yesterday. It was a fun discussion. And, the punchline was, when you give up control, that the people that grab control may get rid of the people that you've grown with and fell in love with, and that's part of the process. But it was that's what you guys got in the deal for, right? Was to give up control someday.
Part of the objective is to get fired, right? As an early stage director, if you can get fired by bringing in a large venture capitalist who has the background, has the checkbook, and can help the company, that's a good thing. Okay, well, with that, we'll transition governance questions or catch-all questions to the group. Paul?
So Ren said something I thought was interesting, why you guys excel at kind of that earlier stage, maybe not so much in. Just to flip it a little bit, what about from an entrepreneurial perspective? There's so much money sitting on the sidelines, who do you take it from, and who you're willing to give maybe better terms to that maybe you wouldn't give up as much in the negotiation. So from an entrepreneur, how do you look at the potential investors and evaluate what they bring to the table?
So that's am I on? I'm not on. Come on, okay. So that's a great question, because an investor should be valued at more than just the cash that they're bringing. So at the end of the day, if I can raise $5 million from an investor or an investor group or two, right? I have two options. I should really choose the one that I think, one, there's great chemistry. Two, that they bring a lot of value to the work that we're trying to accomplish. This is about building a company collectively, investors and founders together. So it's truly a partnership. And if you don't have that partnership or you don't have the chemistry, I would look for a different relationship.
Now, there is one caution that I'd like to speak to the issue is, when you're looking at to the investor on the early stage company, money is fungible, knowledge is not. All right, so if you have someone in the industry, okay, who can help you, introduce you to customers, to suppliers, maybe help you on the manufacturing process, those are more important if they're willing to put in money. The caution that you have to be is you should not tie yourselves to one strategic partner. Everyone is saying, oh, Johnson & Johnson or Amazon is willing to invest in me. And that's a great thing. But they will want often a right of first refusal, or a right to purchase your company and the price. And like anything else, if you limit yourself to one potential suitor, you have limited your upside possibility. So, while it may be good to talk to a strategic, having a strategic as an investor with all of the strings that they may put on their investment may not be the smartest thing for you as an investor, or for your angel investors.
Harry, did you have a question?
Just curious, what reporting requirements does North Coast have for their investments?
So we require in the deals that we lead there to be monthly financials that come to the fund. Those don't typically go to the full membership of the fund, but they do go to any direct investor. So if you did a $20,000 sidecar, you would be treated the same as we would. You'd receive that same level of reporting. Then we ask the entrepreneurs to come to a member meeting each year at a venue like this and to present an update. It's partially for us to receive information from them, but it's also to hear from them how things are going and what they need from us, what sort of resources we can bring as a group. And we use Jumpstart's CRM and reporting system, which has been expanded really to all of the players in Northeast Ohio to survey these companies on a regular basis, and that makes it easier for them to report on the non-financial aspects.
How good are they at complying?
Mileage varies. And it's difficult for us or any investor with a lot of companies to stay on top of that and to make sure that we're hearing things. And like anything in life, you tend to hear more from people when things are going really well. And there's some companies and entrepreneurs, when you see an email come in from them, you know they're raising money, and you know there's not a lot of money in the bank. Right? So the more they proactively communicate, I think go above and beyond whatever they're legally required to do in the documents, the better. Mike?
So that raises an interesting question. In deals, companies that I've invested in outside of Ohio, let's say, they tend to give monthly or quarterly updates to all the investors by email. I don't see that as much in Ohio investments. Any insights or thoughts into that?
I'll make a comment on that. So it comes back to relationships. If I'm writing a check, I feel better if I'm getting updates, whether it's good or bad news, right? Certainly want the good news, but I want to know when things aren't going well, and I don't want surprises. I think it's good practice for founders to remain in touch with their investors within reason. And I think we're probably less good or less familiar with doing that in the Midwest than maybe West Coast or maybe Northeast startups are.
So it's not just, here's information, it may be, hey, we're looking for contacts.
Could be anything.
With this, whatever.
Yeah, I mean, that's great. I would love to see more companies doing that. I would love to see more companies in the portfolio, not just saying, here's what we accomplished, but here's where we need help. Because if I know where you need help, then I can try and help. I can find help, right? If I don't know that and I can't be part of a solution, then we're slowing the progress of the company. And if you multiply that across a base of investors, you potentially have 10, 20, maybe more individuals that could do something if they have capacity and bandwidth to do it.
Any last question? Yeah, John?
What would you guys suggest when you have kind of a rogue CEO who's doing things that aren't really the way things should be done, and governance comes into matters as a board member? What do you do to try to reel in somebody who's not behaving the way they should be? We've seen a few of these at Jumpstart, and I'm sure both Brendon and Michael have seen them too.
Again, it gets to the point of how much control that board has, okay? How much ownership the owner has. I mean, we've all seen, and it's not limited to private, startup companies. We've seen public companies, including public companies, in Northeast Ohio with rogue CEOs that you have a very difficult time getting rid of. But, sometime, if you have the votes on the board, you monitor it, and there have been cases where, such directors have been removed. They still keep their ownership, but sometimes there's a need to take action.
Yes?
So to go along with your point, I think that's a really big thing that you kind of think about when you're investing money with someone. And so my question is, from an investor standpoint, how do you determine what portion of your investment is good enough for the founder's salary? Because, founders, if they can't make the business grow if they're not, paid and they don't have necessities, food, water. So how do you determine a respectable salary where they're not concerned, but still, like you said, not buying McLarens and 918s?
I mean, it depends. I mean, you probably have control of what you see. You have more established companies, so you're probably paying higher fees in terms of salaries because
yes, sometimes. At the end of the day, if the person's not making, there really is it's part of a math problem. If the person isn't making enough salary to to live the lifestyle that they're accustomed to, it's probably not going to work. And so that's a big issue with us, is that the person's making, and for some people that's a lower number than others. But we've tried in the past to get somebody's salary down below what they know that they can live on, and we've had to take passes because that number doesn't work. So I mean, it really is a math problem.
Yeah, I mean, at North Coast Angel, I mean, we looked at one company where the three founders were each wanting to take out in excess of $200,000 each, and they were raising $1 million. And there was no sales yet. I mean, there was some limit. I don't know what you think. I mean, for my own personal start, somewhere maybe between 1 and 200,000, for the CEO. Depending on it, maybe sometimes even less. I mean, the key for them is the sweat equity. You have to make sure that they have enough, for their 3 children and ex-wife and others, but you don't want to go overboard.
Or the ex-husband too.
Or the ex-husband.
Right? Yeah, so I think that's more of an issue, especially at the early stage when a company is just getting up and running. They're not profitable. Brendon, I presume that the companies you're investing into are profitable, or not always?
we intend for them to be profitable.
Soon to be, and for a really early stage company, the type that you might make an angel investment into, or that might be raising a seed round, knowing that the founder is not going to be under some degree of stress, because if they don't hit their let's say revenue milestones, everybody's going to be taking a salary cut, and they may not be able to pay mortgage or feed their family, put shoes on the kids. Those are really important things to understand. So you do want to look at the budget milestones, the use of capital, make sure that there's sufficient funding, that the milestones are really seem very achievable given the team. You are placing a big bet on the founder and the team that they've put around them. So you do, as an investor, you really want to feel comfortable that they can execute on the mission, that they can be successful, and if you feel that they can't and that they may walk away and go get a full-time job somewhere, then you ought to think about that and have that conversation with the team.
Again, there are no benchmarks. You have to talk to the individual. The one thing I would just throw out as an example, if 50% of the money they're raising is going out in salaries in the first year, and most of that's to the CEO, I don't think that's a problem. It's a problem. If that's going out because it's the tech team, and it's going out to 10 IT people, that's a different question.
Yeah, and I would add, really understanding how the founders think about what they want to accomplish with the business is important. And salaries, looked at some salary data. Salaries tend to be higher for founders in the Midwest than they do in Silicon Valley. Silicon Valley salaries are lower, and they raise more money, and they structure their salaries low. And how they do it, I have no idea. If you're in Silicon Valley, where the cost of everything is astronomical, but they do it because every dollar invested into the business, into things that drive growth, is going to return, if things go well, some multiple greater than 1x. And me taking home as a founder a $200,000 check, when maybe I could get by on $100,000 or $75,000, and the balance of that could go into growth, or maybe hiring that, some other key resource, is a really fundamentally important understanding of how founders think about their company and what they want to achieve. So they shouldn't be showing up to get a great salary. If they want that, go down the street and get a job from somebody who will pay you 26 times a year.
I don't know if you care to guess. I'm just curious. What do you think the average salary is for a North Coast CEO? I mean, you took all the companies and combined.
Yes. So we have that data to be sure. The low salaries we've seen over the years are 50. We've seen some people start out at 50. Those are typically people who don't have families, right? Who don't have an expense structure, or people who have done very well in their previous ventures, who, just as Rem said, would rather put that money into someone who's either making something or selling something at the company. $100,000 is not an unusual salary. That's an interesting point where someone can often have a family, where that's closer to what they may be making in the competitive market, but it's usually less as a founder than they would get in the real world. Where we tend to see the higher salaries, I should say where we tend to tolerate the higher salaries, is specifically in life sciences, where to get that level of expertise, you typically do need a specific type of person, or when they're non-founder CEOs. You really have to pay for a non-founder CEO. I think it was mentioned that when a non-founder CEO comes in, they may get anywhere from 4 to 8% equity in the company. That's not nearly as much as the founder would have had. They make up for it in salary. So when it's time to bring in a professional CEO, you need that higher salary, and I think that's one of the catch-22s to John's question about what do you do when you have a rogue CEO? Because when you need to replace the CEO, that's when it's hardest to replace them, because the company typically isn't doing so well and there typically isn't a lot of money. So it creates a very challenging circumstance, and it's one of the reasons I think we as board members need to get ahead of those situations and not be reactive. Well, if there are no other questions, we have a bottle of bourbon to give away. And then we'll wish everyone here the rest of the evening. Maybe we'll look for the help of our panel in selecting that winner. Let's see, do we have a, we've used different systems each time. Okay, so we have 70 RSVPs for tonight, 27 guests. And each of those guests has a number next to them. So why don't, Brendon, since you're standing up and that qualifies you, why don't you name any number between 1 and 27, and Rem will have you read whoever corresponds to that number.
4.
James Dempsey.
All right.
I mean 12.
Congratulations. Yeah.